The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
So it is Friday the 4th of July. Jeremy, welcome back.
Hi, Gareth. Yeah, good to be here.
So 4th of July, obviously US markets shut and our colleagues across the pond will be having a well-earned break. What have you seen going on in the macro world for the earlier part of this week? Where do you think we've got to?
I would say that over the course of the week, whatever you think of Daddy Trump, he's had another good one, culminating overnight in the passing of the big, beautiful bill.
Yeah.
Which many have been critical of, including myself, as it takes the form of the biggest ever increase in the federal government debt ceiling of just a short $5 trillion. Nothing really to write home about there. And an estimated increase in debt over the 10 years of the bill's life of $3 trillion. So there's much in it to be concerned about. I would say all of those concerns and many more have been voiced over the last few weeks and months pretty vocally, but it's done. It's behind him and he's paid a political price. But thinking about this last week and sort of do a compare and contrast job with what has happened in the US in the first 6 months of this new Trump administration, he has got a lot of things done. Like it or not, he has restructured the terms of trade for the world. He's shaken up European defence spending, permanently reduced direct taxation in the US now, and will now be focusing on plans to deregulate the US economy as he sort of doubles down on his efforts to bring jobs back to the heartland of the USA and make America great again and do all those things he's pledged to do. So if you step back and look at that, at what he's achieved with what is a very slender majority in Congress and contrast it with what happened this week in the UK, and I'm not being party political here, you know, while Keir Starmer may have done a better job than we may have expected him to do in the foreign arena, in foreign policy, in handling Trump, for example, or opening up improved relationships with the EU, his ability to get things done, such as reform welfare and control the UK's fiscal position, despite having a large parliamentary majority, just illustrates how much more dependent the UK is on the good faith of the bond market than is the case in the US. And the collateral damage caused this week to his chancellor on show for everybody at that disastrous Prime Minister's Question Time illustrates that point very clearly.
Yeah, and I suppose it makes the point that your majority is only a majority if you can use it. And I think that's what Starmer's seen. He's been held to task by the backbenchers, and it's been shown quite clearly where the power lies. Whereas as Trump, as you say, has a wafer-thin majority, but he's got the big, beautiful bill through, and it feels like he has achieved an awful lot. So does that make Scott Bessent's job easy for the rest of the year, do you think? Or is he still facing a few challenges in terms of selling those US bonds that need to be disposed of?
Well, I think it brings his job now for the second half of the year into sharp focus. So if you look at the time that Trump has been in the White House, the US Treasury yield has fallen by about 50 basis points, whereas coming back to the comparison with the UK, in Starmer's first year in office, the 10-year gilt yield has risen by 50 basis points. Now, you quite justifiably argue that you're not comparing like with like in that, but it is indicative, and one can't help feel that the UK government, you know, just 1 year in, is already boxed in by political forces, largely from its own backbenches, but also by the bond market. You know, and the irony of all this is comparing Bessent with Rachel Reeves. Reeves, ironically, probably only still has her job today because of the reaction in the bond market. The bond market was basically saying, whatever you might think, the alternative right now is probably worse. So coming back to the question, Scott Bessent now has a huge challenge of using the bond market to get on with the job that he hasn't been doing in the first half of this year, which is refinancing the debt that is coming due. And by most estimates, he has to sell and refinance well over $1 trillion worth of longer dated US paper in the next 6 months. And that is a huge order. So his task as a self-appointed world's biggest bond salesman is going to come into sharp focus here.
And he hasn't been selling bonds at a sufficiently fast rate in H1 to keep up with effectively the building level of demand or requirement for that to be done. So there's an increasing pressure on that bond selling capability.
Yeah, the term premium has moved out, so it's more expensive and more challenging to sell longer dated paper. So the world is financing itself on shorter duration paper, and the US is definitely doing that. But yeah, Scott Bessent needs to bring out his box of tricks here. And one of the things he needs to do is magic the 10-year yield down to that 4% level or below, which, given the stronger than expected labour reports this week, the non-farm payrolls, his job has actually been made that bit more tricky because the rate at which the Fed is likely now to reduce rates has lessened, and the slugfest between Jay Powell and Donald Trump is likely to intensify. So if that reaches breaking point and Trump sacks Powell and brings someone in to reduce short-term US rates, I think that could backfire quite badly.
Well, the market certainly reacted very badly to rumours of that sort of behaviour a while back. So ironically, the amazingly strong US economy, its ongoing strength actually makes Scott Bessent's job more difficult by meaning that Jay Powell's less likely to reduce rates.
In some ways, yeah, that's true. Yeah.
All right. What else has been going on then? Anything else?
Of course, we've reached the sort of halfway point of the year this week, the end of Q2. And so Q2 2025 was really bookended by two critical events. It was obviously Liberation Day on April the 4th and the US bombing of Iran and their nuclear facilities on June the 21st. So we've had a very roller coaster quarter, but overall, year to date, the S&P 500 is up something like 5%. And that sort of masks a 15% drawdown at its low point in early April. So most other equity markets have followed that pattern. But of course, the other thing that's cut through all this, and while all markets have had similar trajectories, it makes a big difference in this period, this half year, this quarter, in terms of which currency you measure all this in, because the big feature is the continuing slide of the US dollar, which is down on a trade-weighted basis by something like 13-14% year to date now. So this is a big move. And in terms of showing relative returns of stock markets, it's equalized things from the perspective of a non-dollar global investor. So European pension funds, sovereign wealth funds, who aren't measuring themselves on a dollar basis, aren't seeing this continued persistent US dollar asset outperformance. The field has equalized, and I think European markets are showing their mettle again. Now, what we've talked about before, this sort of rotation out of US assets, albeit not happening quickly, I think is grinding away below the surface here and is going to be a continuing feature.
So for a sterling or euro-based investor, you may have seen a 5% rise in your holdings, assuming it's sort of S&P or similar sort of proxy across H1, but you've lost more than twice that much on the currency.
Yes.
So that hasn't been a great half year, if that's been your strategy. So if we do see some continuation of that rotation away from US equities, then European equities, and even, dare I say it, the dear old UK could be one of the beneficiaries.
Yeah, and I mean, it's like a crack record. I think the UK market still looks relatively attractive in this scenario, and our assets are continuing to be attractively priced for strategic and international and global investors. And while our domestic investors aren't piling in, the companies themselves, the ones that have survived and come through all this, are buying back their own shares, and they're being acquired at attractive premiums. So these assets are becoming scarcer they're undervalued, and I think that makes them relatively attractive. So I think one of the key features to look for as we go through the rest of 2025 is whether the UK IPO market opens back up again. It is sort of opened in the US, and there are signs that it's opening up elsewhere, but it's not starting in earnest in the UK, and I think that could change.
Yeah, no, I've also heard a couple of very anecdotal comments from people at company results meetings during the course of this week, actually, which would suggest that things might be starting to improve. So, yeah, we'll see whether that comes to pass. But as you say, that'll be the real test of whether the markets can start any kind of proper broad-based recovery.
So what have you been looking at in the UK this week?
So from the small mid-cap space and the progressive client base in particular, it's been a pretty quiet week, actually. The real highlight was actually Secure Trust Bank, which is, in my opinion, a very well-run business. They've struggled quite badly recently with concerns from investors around their vehicle finance business. And they announced this week that they're going to effectively exit that. They're going to put the existing loan book into what's called runoff. So it just gradually declines over time. And it was a clear, decisive step by management to say, actually, we're taking the decision. This is an area of business that has been troublesome. We don't think that's necessarily going to change, and we're going to exit it and steer our productive assets or our capital into other areas which we think will generate more shareholder value over the long term. So it's a useful boost to short-term pre-tax profit. It was very well received by investors. The shares were up, I think, between 5 and 10% across the week. And it feels like another example of companies reacting to the various shocks and pressures which have been sent in their direction, and shareholders responding very positively to the way the companies have been taking action. So good to see. And I think it's another example of the resilience that we've talked about with regard to UK markets. They've had a shock, an external shock. They've responded well, and investors, I think, are warming to the story. So it's nice news from Secure Trust Bank.
That motor finance cloud has been hanging over a number of stocks in the sector, including some of the major banks, but specifically companies like Close Brothers and S&U, which is a company that's also been impacted by that. They updated the market a couple of weeks ago and said that they dealt with the matter and the worst of the regulatory clampdown is now behind them. Now, whether that proves to be the case or not, I don't know, but the shares are up a good 25, 30% since then. So it does feel as though the market has moved on, at least for the time being.
Although in many ways it's sad because it feels like the UK capital markets are evading the responsibility of helping fund that sector of the market, because these loans probably need to happen. People need to borrow money for these purchases. And it's a shame that that can't be reconciled with investor expectations, or you can't run that in a way which, even if you're doing it well, is acceptable to normal shareholders.
Yeah, I agree. I think it's an area of the market where regulatory oversight seems to have had negative consequences for the provision of a much needed service. If you look at what's happened to doorstep lending, personal lending, what happened to subprime lending, these are activities that are being forced away from the scrutiny of being conducted by public companies, which I think, as you say, is a great shame.
It is. And are we now seeing the rise of lots of unregulated, very shadowy actors stepping into this market, which the properly regulated, well-managed capital is having to avoid or having to escape from because of the worries of investors? So it's a sad outcome. But yeah, for Secure Trust Bank shareholders and potentially those of S&U and others, it feels like the right thing, which is, sad to see. But that's what investors are reassured by. See how it all plays out. So what about next week? What have we got on the radar the next 7 days?
Well, it's pretty quiet, actually. We're going to get some UK GDP data for May on Wednesday, which hopefully won't make Rachel Reeves cry again, but let's see. But I think the main focus is going to be on the July 9th trade deal deadline set by Donald and what unilateral measures the US might take in the situation where some of their major trading partners, particularly Japan and the EU, have failed actually to agree the outline of a trade deal in the time remaining. So, probably a bit of volatility on the back of that, I would expect.
Could well be. So, we'll talk this time next week and hopefully we'll have some answers on that.
Okay.
Great speaking to you. We'll catch up next week.
All right. See you then.
Brought to you by Progressive Equity.